We want to bring in the Great Hill Capital Chairman. We have Thomas Hayes joining the show here to help us break down what we just heard from Fed Chair Jay Powell. Tom, when you take a look at those headlines, trying to walk that very fine line, not trying to sound too hawkish, also didn't want to sound too dovish. Did you do a good job?
A fair job. I think to Dave's point, it's, equity bulls looking for a drink in the desert. He didn't give us much water, that's for sure. But he did leave on the table the possibility of a downshift in December from 75 to 50 or the next meeting. So the point is that the pace will be slowing at some point, even if the terminal rate is going to be higher. So we came into this meeting thinking the terminal rate might be about 4.6 to 5. Coming out of this, I do think that the downshift will be a positive thing. I think the markets will take 24 hours to digest this, and then we'll start to look company by company. But if you look at the seasonality that we're going into right now, we do have the election coming up, and that's coming up very, very shortly. The average return for the S&P in the 12 months following a midterm election is 18.6%. So he's trying to throw cold water on it. He has left the downshift. He came out to the cumulative tightening. He's going to take that into account. He's going to take into account the lag, and then he completely threw cold water on it with the it's premature to pause. So it's kind of double talk here. I think on balance, we've got 2 more CPI prints before the December meeting. We have the jobs report. Unfortunately, the JOLTS report was a little hot yesterday, so we're not expecting miracles from the jobs report on Friday. 200,000 non-farm payrolls. If it comes in hotter than that, market's going to price in 75 in December pretty quickly. If it comes in light, then maybe that downshift still is on the table.
And there's no real indication that CPI number on Thursday is going to be any better. We haven't seen, yes, used cars, we can see. He reiterated the labor market is a big problem. What else did we learn today that we didn't know an hour ago?
Yeah, the labor market is definitely running hot. I mean, we were just talking about restaurants in Connecticut. You can't get a reservation at a good restaurant in Connecticut. So the economy continues to run hot. Labor market's hot. Inflation's hot. I know that there have been major speakers come out saying owner's equivalent rent is miscalculated. It's going to take 9 months to show up in the inflation numbers. We agree with that. The question is the Fed willing to wait and look through the windshield versus the rearview mirror? And right now they're looking a lot through the rearview mirror and not maybe enough through the windshield. I think a good model to look at where we are right now is in 1948, post-World War II, when we'd borrowed a lot of money for the war to fight a visible enemy. Debt to GDP got to 120%. They ran inflation above trend for about 3 to 5 years, 3 to 5%, and that ratio dropped from 120 down to 63 in just 5 years. So we might have to run inflation above trend. He did acknowledge long-term inflation expectations remain anchored. If you look at 5-year inflation break-evens, they're at 265, so they're getting close to the target. And Chair Powell has reiterated he's very concerned about expectations more than actual inflation. So long as that long-term expectation stays anchored, we could start to see the downshifts that we've been looking for, if not in December, certainly in the following meeting.
And as some investors are looking through the tea leaves here, we know that Jay Powell was asked about the 3-month yields, talking about the inversion getting close, not there yet though. And he did say that although it's his preferred measure, they are going to monitor it, but he did seem quite tight-lipped on that. What are your expectations about what the yield market is telling us?
Well, you initially saw bonds get bid on the news that they were going to actually pay attention to lagged effect of monetary policy. And by the time he finished the press conference, we're basically unchanged. The dollar sold off huge initially when we saw we're going to take into effect the cumulative tightening and we're going to take into effect the lags. Now the dollar is just off a little bit. So basically we're unchanged here. He came out way more hawkish in the press conference than in the original statement. So the market didn't love that. But like all of these Fed meetings, what we usually find is the first move is often the wrong move. So give it a day to digest. I think as people say, it's very rare where we come to the table and we say, the economy is strong. This is really bad news. What are we going to do about it? So I think it's a mix here. If you look at earnings for this quarter, they're up 2.1%. They were expected to be up 2.8%. You back out energy, they were actually negative 0.6%. So he is destroying demand. If you look at the GDP for Q3, plus 2.7. If you back out the exports, which was a lot of energy and petroleum products, you actually had negative GDP. So their policy, they have to start to acknowledge that it is working on a lag basis. We started in March, negative GDP. That in actuality, that would be the third negative GDP quarter if you backed out exports. With earnings coming in slightly lower than expected. So these things are working on a lag basis, and the fact that he kept that downshift on the table, I think, is that drink of water in the desert, Dave.
Well, Tom, what if we don't see that downshift, though? Because there's already been criticism out there that the Fed has been way too hawkish up until this point. This was the fourth 75 basis point hike in a row. Powell did say he doesn't have a sense that the Fed has over-tightened or that they have moved too fast. Are you at all concerned that they have been too aggressive up until this point?
I do think when all is said and done, they'll find that they've been too aggressive and they'll have to pivot and actually start to cut sometime in 2023. As we've seen throughout history, it's always the case that they over-tighten. The question is how much they're going to look through the rearview mirror and how much they're going to look through the windshield. And right now, they're solely looking through the rearview mirror. And the reason the market initially rallied was that they said, okay, we will take into effect the lag basis, but then they discounted it completely. So I think when you look at the seasonality of the market, look, if the data comes in strong, it means the economy is strong. The market here at a multiple of 16.3 versus the 18.5 for the last 10 years, a lot of this bad news is priced in. The NASDAQ down 30%, S&P still down 18%. We have priced in a decent-sized recession at this point, but stock selection and sector selection is going to be critical. You can't just say wholesale, all in, risk on. You really have to look case by case moving forward.
Okay, RJ Gallo made the same reference. Look through the windshield and not the rearview mirror. Yeah. Fine, you look through the windshield and tell me how they can even begin to consider pausing.
Yeah, well,
based on what data?
Well, I think first and foremost, you look at commodities. They've completely rolled over since June. So that's going to be felt in the economy. You do see the GDP numbers. Basically, if you net out exports, you're looking at 3 consecutive quarters of negative GDP growth. That's material. You look at earnings coming in lower than expected. You back out energy. You got negative earnings growth year on year. So this is only going to accelerate. So what we would be nice is to see some back off in the CPI numbers, some of the inflation prints between now and December to give them cover. They really need cover. They can't say we're going to predict that the CPI numbers are going to come down in 6 months, therefore we're going to pause. Give them something to hang their hat on, whether, it doesn't appear that it's going to be the jobs report on Friday after the jolts. But we've got 4 major prints between now and December, and maybe they don't downshift in December, maybe it is the meeting afterwards. But he did effectively toggle and say, if not December, then the meeting thereafter, in which case people can start to see the light at the end of the tunnel. And the terminal rate, maybe it's not 4.6, maybe it's 5. But so long as inflation expectations, the 5-year break-even stay anchored at 2.6, I think they'll be able to downshift sooner than everyone thinks, and certainly in the first quarter of next year.
As we've been talking here, the losses accelerating. Dow now off 351 points. NASDAQ off nearly 3%. All right, Tom Hayes, thanks so much for joining us in studio.